Welcome back to another CPI inflation report. We are just 7 minutes away from the report coming out. This is pretty intense. I'm going to go through my predictions as well and give you a quick reminder of what you want to have written down. I just want to be very clear. These next two hikes are really important, or hikes, so used to the Fed. These next two CPI reports are really, really important. They're so important because they set up whether or not the Fed pauses or continues hiking. And that's actually the most critical moment because we've known for the last year that the Fed was hiking, and continuing to hike. And so now we've come to this inflection point where Jerome Powell is convinced that, hey, maybe we've gone far enough. Maybe we've done enough. Maybe things in terms of financial conditions, whether it's credit conditions or just interest rates in general, the real rates we have, maybe things are tight enough. And if things are tight enough, then just perhaps we could pause. That's the expectation, right? But it's all going to come down to these next two reports. These next two reports are extremely critical. Now, one thing that I did notice, which I think is very interesting when it comes to inflation, is when I talked about inflation the other day on the channel, where I talked about you being lied to, essentially, right? Where the mainstream media is taking the year-over-year figures and they're telling you, hey, look, inflation is so bad. Look at all these companies that raise prices massively in Q1, and they're using these year-over-year numbers to tell you how bad inflation is. Well, what was fascinating was I looked at the comments in that video, and there are still a plethora of people who widely misunderstand inflation. There are a lot of comments like, yeah, well, I'm still paying 35% more in car insurance, and my home insurance is up 25%. That's true. And it entirely could be possible. By no regard am I saying that's wrong, but that doesn't mean that we still have inflation today. Because, see, you could pay a lot more than what you paid in 2019. We could literally have had 50% inflation on every single category between 2021 and 2022. But what we care about is what prices are doing between 2022 and 2023 when we're evaluating what the Fed is going to do. Now, I understand from like a household point of view, it's a pisser that we're paying a lot more money in medical insurance, health insurance. Well, obviously that's health insurance, your homeowner's insurance, especially if you're in Florida, your car insurance. Restaurants are more expensive. A McDonald's is more expensive. The groceries are more expensive. Absolutely correct. All of those things are more expensive, but that has nothing to do with the inflation rate between 2022 and 2023, because a lot of those price increases occurred between 2019 and 2020 and 21, and 21 and 22. And so that's a really important distinction because we're basically, we had 2 years of money printing, 2, 1, and or 20, 21, and 22. That's a lot of money printing. So there is a really big fundamental misunderstanding of inflation that actually I think is leading a lot of people to be significantly more bearish than they should be, because they're thinking, golly, why would the Federal Reserve ever cut rates? Why would I invest in stocks? Well, I mean, like my car insurance is up 35%. Well, why would I do this? It's never going to go back down. Correct. It's never going to go back down. It's not going to go back down for a very long period of time until artificial intelligence starts replacing companies like Lemonade that built their whole business model around the idea that they have an artificial intelligence chatbot that probably ChatGPT just put a big knife into the back of. I hate to say it for Lemonade. But prices and the way inflation works is very different from what we think sort of on a daily basis. And if that misbelief is guiding you into a direction of investing in a way that that believes that inflation is here to stay forever, you ought to be careful, because the odds are it's not going to be here forever. The actual fight right now is how long is it going to just stay slightly elevated? And that's going to help us dictate how long rates are going to stay high. But keep in mind, inflation does not need to go down to 2% for the Federal Reserve to cut rates. Inflation just needs to trend towards 2%. And Jerome Powell gave us the formula. Real rates have to be 2%. So if inflation expectations fall we could actually see a 1% rate cut, even while we're still above 2% inflation. It's really incredible. He gave us the formula. Just watch his last meeting. It was remarkable. But anyway, so we are now 2 minutes away from the CPI data. The CPI data set, this one's going to be big. The month over month and headline stuff, I don't really care about. I care about core, as everybody should. So month over month, we're looking at 0.4, but we're also looking at 0.4 for core. So that's an easy thing to remember. I thought that was 0.3 at one point. It looks like it got moved up in the last 24 hours here to 0.4. So we're looking at 0.4, 0.4. And then for the headline number, thanks to a little bit higher of energy prices last month, we're looking at a flat read of 5% year over year, 5%. That's the same as what was in the prior read. And then the most important, in my opinion, is that core 5.5. That's X food and energy. I really want to see that come in at 5.4. So my expectation here is a match on the headline core. So headline core match 5.5, CPI year over year 5. And I'm really hoping that we could see that CPI core month over month come in at slightly under, just 1/10 under would be fantastic. But we've got about 40 seconds left, so we'll see what we get. And then we'll go through the report. So buckle up. It's going to be exciting. I'm excited. Anyway, so again, 25 seconds left. Remember that tonight we've activated the $120 price increase for the AI course on actually making money. So not just here's a list of stupid tools, like we're actually going through, here's how to actually implement this into a business as an entrepreneur, how to make more money, get SH9T done faster, best price guaranteed for life and lifetime access. Here we go. And CPI month over month is not out yet. Okay, 0.4, 0.4, 4.9, and 5.5. I freaking nailed it. Let's go. No way. Is that right? No, I know they flip-flopped a little bit. But anyway, CPI year over year, 4.9. The core was 5.5. Dang it. That's the one I thought was going to come in 1/10 under. I was wrong. Never mind. 4.9 year over year. That's good. 5.5 is just basically a match on the core, and then match on the core 0.4. So really matching expectations. That's good. Dang it. I saw that 1/10 below, and I got so excited. I'm like, no way. But that's okay. It's okay to be wrong. So this is good, though. So we got a match with one number coming in slightly under. It's not a beat, which is like, it's not a bad number, which is good. In other words, we didn't get something higher here. Let's go through the details now. Now we got to see the big one is going to be core services, X housing. That's a big deal. Wall Street is calling this bang on target with expectations, which is good, because another thing that creates a lot of uncertainty in our markets is the fact that, these numbers have been all over the freaking place lately. All right, consumer prices rose 0.4, seasonally adjusted, fine, after increasing 0.1, but that's mostly because of the energy. This is the number that came in 1/10 below, 4.9. I get excited about that. Let's see here. Then we've got all items less food and energy rose 5.5. That's the one I was hoping would come in at 5.4. It came in at a match at 5.5. Okay, let's see here. The other sectors. Shelter was among the largest factor. Still, are you serious? Less food. Among other indices that rose in April was the index for used cars and trucks, which increased 4.4%. Used cars still popping off. That's crazy. Some of the leading data was saying they're finally rolling over, but apparently not in CPI. The indices for recreation, household furnishings, operations, personal care, apparel. Personal care, we don't like to hear that, also increased in April. Several indices declined in April, led by airline fares, which fell 2.6% over the month after rising in Feb and March. New vehicles declined 0.2%. Medical care services unchanged in April. Hospital services rose 6% annualized. Those are a little volatile. Okay, index for all items less food and energy 5.5. Shelter index increased 8.1% over last year, accounting for 60% of the increase of all items. Other indices with notable increases over the year include motor vehicle insurance. We've been talking about that. Household furnishings, operations, recreation, and new vehicles. Okay, let's get into the actual report. I want to see the X housing one. That's going to come through in just a moment. Let's see. Annual increase a little cooler than forecast. That's good. Equity indices surge higher in pre-market trading. 2-year yields are at the low. Well, yeah, because again, we We just don't want to get the rug pull, right? That's what people are hedging against. Let's get the actual detailed sheet, which is really important. But people do not want to get rug pulled. The rug pull comes from the inflation reanimating. That's when you're screwed. If inflation reanimates, we're done. Because then you get Paul Volcker. Because then inflation expectations get ruined. You get Paul Volcker. It's hell. Like even a coupon code that expires tonight is not going to save you if inflation reanimates. It's just gonna be bad. Okay, so getting the actual charts here is taking a tiny little second longer. Biggest contributor was housing. Yeah, we already read that. Come on, Wall Street. Give me something I didn't already know. And give me the data, please. All right. There we go. Got it. Okay, here's the chart. This is the fun part. Okay, I'm going to go straight to the back, folks. Straight to the back. Here we go. What do we got? Services, legal services. Come on, man. Oh, wait, what column do we want? Hold on. Column. You want the far you want the far right column. We got to check out the far right. What is the far right thing? All right, here we go. Financial services. What the hell? 4.1%? Is that can't be right. Hold on a sec. March to April. My goodness. Oh, well, come on, man. That's tax season, dude. Okay. Okay, so financial services, yeah, tax prep. Look at that, tax prep up 6.4% this year. Oh, God. That's month over month. That's horrible. Laundry and cleaning services, 0.5. Miscellaneous personal funeral expenses down a little bit. Okay, a little cheaper to get a funeral. Miscellaneous personal services, 2. That's bad. That miscellaneous personal services, that's not good, that 2.4. It accounts for less than 1% of the CPI weighting, but still, come on, man. Postage, 0.2, that's okay. That's stable, good. Education, 0.1, fantastic. That I like. That's very, very good. Photography, negative. Well, yeah, ChatGPT is a little bit of a problem. Photo processing just got replaced, man. Okay, maybe not. I don't know. We'll talk about that in a different video. Other recreation services, 0.2, good, stable. Pet services. Oh, again with the pets, man. People and their pets. It's a good thing. We actually just introduced a dog to the family, which has been really cool. 0.6, purchase subscription, rental of video. That's high, but who rents videoing? What is that? Is this like Amazon Prime or some nonsense here? Okay, recreation services, 0.7. That's hot. Public transportation. Oh, thank goodness. Look at that, minus 5%. So good, nice little weight down. All right, motor vehicle insurance still rising on a month-over-month basis. That's not great. 1.4% over here. Not good. We've got transportation services, negative 0.2. Okay, good. Health insurance. Oh, health insurance actually coming down. That's good. Medical care services, we're at negative 0.1. That's good. That medical care services is a much larger segment here than some of these other services where we're seeing a rise. Household operations. What is this? Domestic services. What the heck is a domestic service? Come on over to my house and give me some domestic service. Maybe that's like childcare at home or household cleaning or whatever. Water and sewer and trash collection, point to fine. Okay, here we go. Here's housing. I mean, just 60% of the increase built in here by housing. Still waiting for this segment to fall. Rent of shelter, it is coming down. You can see it's off that 0.7, 0.6, now 0.5. That's still 6% year over year. And this is a month over month figure, right? So 0.5% month over month for rent of shelter. I'm hoping this slows down. Jeez. Lodging away from home down 3% month over month. That's good. Owner's equivalent rent still sitting at 0.5% on the month over month basis. Good Lord. Okay, what else do we have here? Super core price index let's see, hasn't updated yet. Yeah, everybody's waiting for it. Founder of Inflation Insights is calculating it at 0.1%. A collapse, he says. That would be great news. Yeah, everybody's kind of sitting and doing math on like super core or inflation X housing right now. That's what everybody's waiting for. So if you're waiting for what the next big piece of data is, it's when people actually sit and do the math of the inflation X housing. Sharif of Inflation Insights points to core services excluding rent and owner's equivalent rent just rose 0.113%. There you go. First math numbers in. That's the category Powell has been focused on because services X housing have been lifted by the tight labor market. That would be really comforting for policymakers. Okay, let me write out what this is, okay? This is really important. So remember this, 60% of inflation that we just saw, of CPI, equals housing. Okay, housing is a type of service, right? We have goods, which are deflating. We have housing services, which should roll over. But honestly, we've been saying that for like 6 months. We're still waiting for it, right? And then you have services X housing, and these are extremely sensitive to labor. Like you saw tax prep was up like 6.4% in the month. Well, that's because labor is so freaking expensive, right? So services X housing, extremely sensitive to labor. What do we have here? We've got 0.113% right here for core services, excluding rent and owner's equivalent rent, according to this guy who's named the sheriff of inflation, or I don't know. It's not spelled like sheriff. It's spelled more like Sharif. Okay, what else do we have here? Supercore application specialist. Let's see, shows a breakdown of month-over-month Supercore figures, services excluding rent of primary residence. Okay, here we go. Let me get this chart up. Quick note, by the way, if you are interested in interning with me, we want to grow the intern base a little bit. Send an email over to jobs@meetkevin.com. Maybe have like 1 or 2 openings. Jobs@meetkevin.com. We've got a great team right now, but jobs@meetkevin.com. Send like a 60-second video or something like that. And it's basically, it's minimum wage. I feed you, I pay for travel, entertainment, all that kind of stuff. But it's minimum wage for the first year, minimum wage. Sorry, you have to prove yourself, and then you get paid more if you're good. Okay, what is this chart? Look at this chart. So take a look at this. Estimated U.S. Supercore CPI month-over-month percentage includes top-line contributions. So what do we have here? We've got 0% on the bottom. We've got, there's the water, sewer, trash collection, medical care minus. You see that recreation really popped off here. Education was only like 0.1%. So some of those larger numbers that we talked about, they're here. But it's just everything else is negative, which is absolutely great. Okay, cool. So I like that. Max, you should hit us up too. I know you're from Canada. But anyway, hit us up again. So what is this? Anna Wong, Bloomberg economist, chief economist, was April study core CPI shows inflation is not receding fast enough to justify current market pricing for sharp cuts by the end of the year. That said, Bloomberg Economics believes the Federal Reserve is now placing greater emphasis on credit indicators. And with so much uncertainty over future credit conditions and the debt ceiling risk coming to fore, officials are likely to be less reactive to any single inflation report surprise. This is good, though. So far, I would say what you have here is an ad expectations report. But in addition to an ad expectations report, that Supercore, if it really is 0.1, that is absolutely phenomenal. Because understand this. And then I want to talk about the stock market for a moment, but understand how this works. Take this number and multiply it by 12. Please do not make the mistake of trying to create an exponent formula out of this. Okay, so really you're sitting at 1.36 annualized inflation in this report for Supercore services. That's really good. That's absolutely fantastic. So I'm really excited about that. This is a very good report. It appears like as a result, the market is cheering that. You've got, just look at how we've been at these levels before, so it's not that great. But you're definitely seeing some excitement here. You've got that tenuousness going into today, some excitement. It's not like a rip-roaring level of excitement, but it reiterates the Nike swoosh. Here's the thing. A lot of people ask me about this Nike swoosh. They're like, look, Kevin, this swoosh that you keep talking about, how long is it going to take? Long. The reason it's going to take long is because it's going to take a long time for people to get used to the idea that inflation could actually end up proving to be the T word, transitory. Now, I say that and people think I'm nuts. They get mad at me in the comments all the time. But I really believe that when we're sitting in 2030, we're going to look back and we're going to have seen inflation that probably looked something like this. So that's your low inflation. Then you got the insane inflation. Then you've got some inflation like this, stays higher for a little longer, right? And then you're potentially fighting deflation. So when we're over here in 2030, we're going to look back and go, well, yeah, duh, that was transitory. That's when we reached escape velocity on money printing, basically, where all of a sudden the rate of money printing, the first derivative of how much money we were printing, skyrocketed. For the non-math people, that's basically like you were always printing money, but all of a sudden you just went, and that's what led to the inflation. It's like accelerating really fast in the car and being thrown back into your seat. And so as this goes down, I think proportionately, you actually end up seeing, so here's your Nike swoosh, basically, as this inflation skyrocketing, you have your down, and then you have, as people start waking up and realizing, oh, inflation's going away, you have your elongated Nike swoosh, and it doesn't necessarily mean it's going to take to 2030 to get to new highs, but eventually that'll be better. But I do think because there's so much uncertainty and volatility, it'll probably look something like this. And that's roughly what we've had. And it's basically what I've been talking about for the last 6 months. This hope that this is something we've seen. So far, the data is consistent with this. And I'll be the first to flip-flop on this if, and I'm going to flip-flop on this if the data's wrong. I change my mind based on the data. And I know, like sometimes that's frustrating because like, hey, like Kevin, do more of the live streams. I love doing the live streams. Like I want to do the live streams every morning, but the data is telling me don't do the live streams. So like there's a really cool core of y'all who love the daily morning live streams, but the data says don't do it. And so it's very conflicting. Like the data says is actually bad for the viewer. Like it has nothing to do with money. I don't care about the live streams. Live streams, you could watch most of the live streams anyway without an ad in them. But anyway, okay, so I just do longer course member live streams now in the fundamental analysis. So let's do a little bit of Q&A. Keep in mind, get that lifetime access to the course member live streams. A link down below. You can guarantee the best price if you join before this evening. Email us if you need a bundle coupon at kevin@meetkevin.com. And if you are sending a 60-second video and you're okay proving yourself for a year at minimum wage, send that to jobs@meetkevin.com. All right, so yeah, we'll probably do the course member live right after this. Nick T tweeted. That's a good idea. Let's go take a look at this. Let's see here. Okay, so does Nike swoosh better for the S&P or Russell? Well, technically, it should be the Russell, but the problem with that is I don't like saying the phrase like this time is different, but here's the problem. If artificial intelligence and the revolution we go into favors larger companies, smaller companies could end up getting whacked. Like I'm not sure if Lemonade is in the Russell, but let's say it is because it should have a small market cap, right? So you look at a Lemonade stock, it's a $1.14 billion company. Well, if artificial intelligence basically creates 50 more Lemonades, and Lemonade spent all of this money investing in an artificial intelligence chatbot that everybody can just plug in. And Lemonade is now sinking in debt because of all their expenses on that chatbot. If that's true, then, and somebody else can just plug in ChatGPT and create an insurance chatbot, then you're screwed, I don't know that you could bet on all of the small cap companies if there is a real risk that AI actually potentially crushes a lot of small cap companies. We don't know. But Zoom dragging along the bottom. I mean, quite frankly, Zoom is like the problem with Zoom is where's the mode? I mean, now they're trying to get into the big thing that they were trying to do after, Microsoft came out with what is it, Spaces or whatever. I don't think it's called Spaces, whatever, Meets or whatever. Google's got one, Apple's got one. Everybody can send you a link and it doesn't have to be Zoom anymore. So what did Zoom do? They got into setting up offices. Well, nobody cares about the office anymore now. They did the Zoom TVs and the Zoom rooms and the Zoom conference rooms. That was supposed to be a big, income source. But now you've got Amazon, who was building 2 massive offices outside of Seattle. That's like, nope, it's crazy. Just a trade, not long. Oh, thank God. Yeah. So I think you could pretty much invest in anything on the Fed pivot. Look, people think I'm crazy for that. People really, they're like, Kevin, what do you mean? There's been so many cases where the Fed pivots and then everything goes down. Just type into YouTube, Meet Kevin Fed Pivot, and you'll get the, like all the facts and details on that. But let's just put it this way. The one concern this market has is inflation. And if inflation is gone, this market pumps, man. Dude, Open Door up another 12%. This is remarkable. So remember, we did a course member live, and I talked about this on the channel, that when this sucker was $1.50, I'm like, this thing's going to go to $2 or $3. It's so undervalued. It's been up like 60, 70% in just the last week. It's absolutely incredible. That was just pure fundy on that one. Well, a little bit of TA because it was also trading at around the bottom range. So both combined is pretty OP. Anyway, oh yeah, Nick T. That's right. I was going to look at Nick T. I went to Twitter and then I totally forgot what I was doing. Okay, Nick T. Nick T says CPI core up 0.41 in April. Yeah, but that's not the hold on a second. Let's see here. Core 0.41%. Okay. Yeah. But 60% of contribution still from housing, right? So he's right. Like, this is the core. But the thing we care about right now is core X housing. And if it's true, based on what the inflation sheriff or whatever said, that core inflation X housing is 0.11%, we are in a glorious place. Let's look a little bit more. Let's see here. Some of the details are promising for future inflation. Let's see here. Bull steepening is warranted. The trend of inflation didn't reaccelerate as some feared. Thank freaking God. I do not want this reacceleration of inflation. Good thing we're not counted in CPI. We can raise prices without affecting CPI. Okay, chief economist Dreyfus and Mellon. What is this? Was today's print disqualifying the Fed's action in June? Ooh, that's the question. Here's another sign of supply chain problems getting resolved. Appliance prices fell 1.9% in April, the most ever. Major appliances category down 3.4%, the most ever. Oh, wow. Gasoline, the most up since October of 2022. That's part of the 0.4% gain. That's the energy section for the headline, although core is also technically 0.41. Airline fares falling. Great. Super core inflation. Let's say super core services inflation. Let's see here. Okay, we talked about this. It's that X shelter, which is fantastic. Core CPI year over year, X shelter. Ooh, core services year. Ooh, that's a good chart. Let me show you this one. And then I want to show you the month over month. Hold on a sec. Get the chart, Kevin. Get the chart. All right, this is going to be core services X inflation that I'm going to show you, and it just shows it to you in the chart. Keep in mind that core services X housing comes in at 0.11%, smallest increase since July. Hey, that's when I was, I think, shirtless on a beach in Germany doing CPI, because it's like so much later in the day over there. Anyway, what do we got over here? Look at this. This is your core services X shelter right here. Dropping. Fantastic. So let's see here. Yeah, that's true. I mean, Steve, you're not wrong. Like, that is the secondary concern, is that did the Fed over tighten? But it all stems from inflation, right? It's kind of like, okay, the guy's got a bullet wound in his leg. Let's, tourniquet him. And the concern is, well, did you over tighten it to where now we're going to lose the leg? That's the derivative concern, right? But the original concern is the bullet wound. How much damage did the bullet wound do? If the damage wasn't that bad, then we can loosen the tourney, right? That's the whole point. And yeah, the market is expecting that tourney to get loosened. And that's because all of the data says the guy's not that injured. Says it, the original bullet wound wasn't that bad. It was a transitory amount of pain. And this report corroborates that, right? So the guy's still talking. Dude's still happy. The guy's still spending. He's trying to get up and limp around on one leg and go spend some more money on stuff because because he's got more money in his pocket. So yes, there are derivative concerns, but yeah, I'm not convinced that that is such a terrible thing. Nobody's buying homes because there are no homes on the market, man. So that's the interesting question: is how much does CPI need to fall before the Fed cuts rates? Well, this is the argument we made just the other day, where we calculate, okay, well, if the Fed wants the real rate of inflation or of real monetary rates to be 2%, well, then it depends on expectations for inflation. If 1 year out inflation expectations go down to 3%, then the Federal Reserve, well, let's see here. 1 year out inflations are 3%. So if, let's say, 1 year out inflation expectations go to 2%, in other words, come September, everybody's like, okay, a year out, yeah, we could see in a year from now inflation expectations, inflation will be 2%. If that's the case, then you could cut rates 1% in September. See, here's the chart of that. We kind of drew this out really quick. So we drew out that if the Fed rate, or rather here in the middle, let me show it to you with the laser. Here in the middle, if the expectation for 1 year out inflation is 2%, and the Fed wants a real yield of 2%, then you could have a Fed rate that actually cuts 1%. So it all comes down to this expectation falling. And today's report will actually help that number fall, right? Now, if the Fed says, hey, the 1 year out expectation is 2%, and we only need a real yield that's positive, and we're okay with the real yield that's at 1% rather than at 2%, now they can actually cut rates 2%. So this is them looking at the leading data, saying, hey, if the leading data says inflation's going to be 2% next year, or it's 3% and we're willing to have slightly less tight credit conditions or monetary conditions, then we can actually cut rates. So the formula is there. In the very last Fed meeting, he literally gave us the formula for cutting rates. Of course, they can't say they're going to cut rates. That's the thing that everybody keeps saying. But Kevin, they said they're not going to cut rates. No, they said they're not having a discussion about cutting rates because they're going to be data dependent. But let's be real. The transcripts of those meetings don't come out for 6 years. So of course they can be talking about cutting rates at the end of the year without us knowing about it. Because as soon as they tell us about it, inflation expectations go up. And it literally does the opposite for this formula. This formula right here wants expectations to fall. Let's look at the 5-year break even really quick. 5-year break even. So 5-year break even. Why would the Fed cut because of expectation? Because that's the whole thing that matters. If you study history of the 1970s, the whole problem of what created Paul Volcker were inflation expectations. That's it. Unanchored inflation expectations are what the Fed is trying to control. There's nothing else, because inflation expectations lead inflation to fall when expectations go down. When expectations of inflation go up, guess what? Inflation goes up. And look, here's a 5-year chart of inflation break-evens judged by the bond market, right? And look at this. Expectations unanchored right here. In January of 2021, inflation expectations blew up and ended up skyrocketing after the war on Ukraine. Well, we ended up getting peak inflation somewhere around here. So you've got like a 3 or 4 month lag between expectations and where you get your peak inflation. And look what it's doing. It's slowly trending down. That's exactly what we've been seeing in the CPI reports. Literally, this is what we've seen in the CPI reports. This slow trend down. And as long as this continues to go down and these expectations go down, the Fed can eventually cut rates. So it's realistic. So at what meeting do we know if Powell is bluffing? I don't know that there's a bluff, because remember, he's not said we're not going to cut rates. He said we're not even talking about cutting rates. We're not even thinking about cutting rates, right? He's basically, he's saying, like, we just need to wait for the data. So when do we have good data? Well, honestly, by June. If this next inflation report also shows core services ex housing at 1.3%, which we just got, Fed's gonna be like, hey, things are looking good. And then they'll probably do something like, if we stay on this trend for the next few months, give it another couple months to September. If we stay on this trend for the next couple months, we don't need to raise rates, and they'll solidify the pause. And then come September, maybe they start saying, hey, we're just going to do the first 25, just the first 25, okay? This is not a trend. We're not talking about cutting more. We're just going to do the first 25, okay? Like, things are going to just the first 25. What do you think's going to happen at the first 25 when the Fed tells you that, hey, man, we're good. Like, inflation's trending down and expectations are going down. Inflation's proving to be transitory. Don't worry, it's just the first 25. What do you think the market's going to think when they actually see the first 25? I'm not talking about a whole 1%. The Fed doesn't need to do 1%. They could literally, they got how many months do we have until September? 4 months. You have 4 months until September, man. You got like 4 CPI reports until September. And if all of those come in low, it's so easy for the Federal Reserve to say, all right, guys, just the first 25. That's it. Don't expect more. Just the first 25. We're not having talks, and we're not even thinking about doing more. Just the first 25. The market will skyrocket. September CPI comes out with a new summary of economic projections as well. It'll be September 20th. It would not surprise me at all with these kind of reports to get a 25 there. And then guess what? You get a 25 in October. You get a 25 in December. You get a 25 in January. January is technically the end of the year. Boom. You had your 1% cut by the end of the year. You have 4 months still left to get 100 basis points of cuts by January of 2024. It's literally there. So as long as these reports keep coming in this way, this idea that the Fed can't cut rates is stupid. Of course they can, but they're going to tell you it at the last minute because, again, they don't want to ruin expectations. So it's actually, this is a fantastic report. And look, let me be real. If this report came in trash and, super core inflation X housing was skyrocketing, I'd be like, well, first of all, the market would be going red. And then we'd be like, this isn't good. Maybe the bond market's wrong. But so far with this kind of report, the bond market's actually correct with this kind of report. So we'll see. We will see. But I'm a big fan, and this is a very good report. And now I'm going to make another cup of coffee, and I'm going to go over to the course member live stream, and we're going to play with fundamentals for like an hour about real estate and stocks. And if you want to be part of it every single freaking day, you get lifetime access. It's a bargain. Any of the courses. Join anyone or bundle up. Email us at kevin@meetkevin.com. Bundle up. Be part of it finally. And every day, fundamental analysis. A lot of people trade on the info. Like I trade sometimes, but I don't trade every day on all the information. But there's a lot of information we go through, and it's great. People just 2x them back. They're fantastic. A lot of good coverage. So anyway, thank you so much for being here. We'll see you in the next one. Love y'all. I don't know. There's probably an outro button I could click over here. Did I do it? I did it. The button still works. Anyway, this is good news. Be happy about it. Yes, there is a path to rate cuts. Of course, the Fed's not going to talk about it other than giving us the formula. They gave us the formula. I'm going to put the link in Discord to the course member live right now. Then I'm going to go make another cup of coffee. And I'll be there in like 5 minutes. All right. And I'm just waiting for this. Oh, look at this. Yeah, man, crazy. Open door. I closed 2 options after getting your notification. Good job letting him ride. See ya.